Hey, this is problem 19B. We're going to show how to analyze the transactions and record them in the proper accounts. So I have the instructions tell me to create a table similar to the one exhibit 1-9, which is what we have here. Assets equal liabilities plus equity. Remember, assets are those resources we own or control. Liabilities is what we owe, and the equity is the difference, or our share. So we start out and we're going to look for keywords in the transactions. So here I see that Raina invested cash. So I would come over and say, okay, cash, they invested cash. Cash is going up $80,000. And why did the cash come in? It was in exchange of common stock. So we have to balance the equation. Here's the common stock, which is our equity account. We put 80,000 on that side. So we'll see that we have 80,000 on the asset side and 80,000 on the liability equity side. The next transaction, rented office space, and we paid $700 cash. The ones with cash make it easier because you know the cash is either coming or going. If I paid, I had to use the cash. So now I want to see, what did I use it for? Well, if I rented office space, then I would be looking at the rent. I don't have a purchase of an office, so this is going to be an expense. When I come over to the expense, I'm going to put the $700 in as a positive number because I need to remember that there is a minus sign built into the equation. Okay. And when we look at the sides, we can see that each side is now have the same balances. So right here, we're keeping track of my totals. I'll highlight the totals as they go along. The side has to stay balanced at all times. Next transaction. We purchased roofing equipment for $5,000. So what did we get? We got roofing equipment and we paid cash. And the balance we owe. So this is a three-part one. So first of all, we look over roofing equipment. That's something we own or control. It's an asset. We have $5,000 worth of assets. Now we need to have something to balance it out so we can be in balance down here. We used cash of $1,000. In the balance it says we're going to pay it. That means we owe the money. It's a liability. It's not a negative amount, it's a positive amount. We owe a positive amount of money. So we now see on this side of the equation, we increased by $4,000. And on this side of the equation, we increased by $4,000. Looking at our totals at the bottom, we see we're in balance. On July 6th, we purchased the office supplies, cash. Office supplies are an asset, something that we're going to put in the inventory, have a cabinet of supplies to draw on. We have a value there of $600. How did we get them? We paid cash. I think that the transactions that have cash are the easiest ones of all. Alright, on the 8th, we completed work and immediately collected cash. So we have here cash. So cash is going up $7,600. Why did we get cash? Why did they give us cash? Because we completed work. Whenever you complete work, that's revenue. Revenue recognition, we recognize the revenue when we do the work. In this case, we got the cash at the same time as we did the work. Checking again, look, our totals are balanced. On the 10th, we purchased office equipment on credit. Key words, office equipment on credit. I look over here. Office equipment's an asset. It's something that we own or control. And we have $2,300 that we have purchased. How did we get it? We got it on credit. So if you think about it, if you're buying, it has to be in accounts payable. If you were selling, it would be in accounts receivable. So that's how you can think about the difference when you see on credit, whether it's a payable or a receivable. On the 15th, once again, we completed work. We already saw that that's a revenue. And it was on credit. So if we did work, that's going to be a revenue, $8,200. This time, the on credit, we're going to receive the money. So this is an accounts receivable. Notice that some transactions are on either side of the equation, but in the case of when we got the supplies for cash, everything was taken care of on one side. On the 15th, we purchase office supplies on credit. So office supplies have increased by $3,100. On credit, we owe $3,100. Next transaction. We paid cash. What did we pay for? So we paid for office equipment, but this isn't a new one. This was purchased in the past. Oops, sorry. Go. Undo. Undo. Okay. So this was because it was on the past. Oops. We know that it had to be, we're paying something that we owed. Okay. So in this case, cash is going down. And the equipment's not going down. So what is going down? The amount we owed is going down. So we paid cash on account, on credit. We billed a customer for work completed. Once again, work completed is revenue. So we would come over here and say revenue. We just earned revenue of $5,000. The revenue recognition principle says that revenue is recognized when the goods are exchanged or the work is completed. They're going to pay us in 30 days. That means that we have a receivable. So the revenue is $5,000 and it's on account $5,000. Once again, we're in balance. We then received the cash for the work that was completed not today, but on July 15th. So that's letting us know that this was cash coming in. Okay. And it was coming in because it was owed to us. So this was to be called an asset exchange. We traded one asset called accounts receivable for another asset called cash. There was no additional income. We then paid office assistant salary. So anytime we pay with cash. Cash goes down. And what did we get for that? What we got was an expense. We have a salary expense. I put it in as a positive number because there is a minus sign built into the equation. On the 31st, we paid cash. Once again, that's the easiest. When you pay cash, cash goes down. Where's the other half? There's two parts of every transaction, cause and effect. We paid the utility bill. Utility bill would be an expense. That would be $295 positive because we owe a positive amount, but the minus sign is built in. Lastly, we paid cash for dividends. Since we paid cash, cash went down, and on this side of the equation, to balance out, we see dividends. That is the payment we give to the stockholders. Notice that in the equation, the minus sign for dividends is also built in. Compare, and we're balanced. Continuing on with our problem, we see that our ending balance is check. So we're going to go and take the next step, which is preparing the financial statements. So I've gone ahead and I've transferred my amounts over so I don't have to flip back and forth between the pages. The first statement you always do is the income statement. Our revenues were $20,800. Our expenses, we could just list the lump sum, or we can go ahead and list them each separately, where we had rent, salary, and utilities, listing each amount. Our total expenses were $2,555. Our net income is revenue minus expense. So we would double underline it to show it's done. The net income is going to travel to the second statement, which is the statement of retained earnings. We started the year with nothing, since this is our very first month of operations. Our net income will come down, and we paid cash dividends. So we look over here at our record and see cash dividends were $1,800. And our new retained earnings would be beginning plus net income and then minus the dividends. So we ended the year with $16,445. That number will come down here as our retained earnings. So we always have to do the statements in that order. You need to do the income statement because net income flows down to retained earnings, and the retained earnings flows to the balance sheet. On the balance sheet, our cash total $87,545, accounts receivable $5,000. We have office supplies, our office equipment, and our roofing equipment. We add our total assets, and we're looking for $103,545. On the other side, liabilities, accounts payable was $7,100, and that equals our total liabilities. Equity, our common stock was $80,000, so our total equity is $96,445. Add the two together, and we hope that they will equal the total assets, and they do. Now, if you want to, we could dress it up a little with the commas but that's not the important step. But what we do see is that total assets equals total liabilities plus owner's equity. And we finish it off with double lines. Okay? That is how you do a transaction.